Ameriprise Financial and the Mirius Group of Financial Advisors, Winchester Avenue. Good morning, Philly.
Good morning, guys. How are you all?
Better now that you're here, Phil. So I got to ask.
I'm glad I could bring pleasure to you guys.
You do bring pleasure.
Wonderful day today.
Can you share? You don't obviously you don't know about this, but you had a funny story for me this morning about what happens to Financial Phil when he gets put under. Can you share any of that on the air?
No, no, absolutely not.
Does it deal with horses?
No.
That might be where the whole concept came from about licking a gift horse in the mouth.
It could have been, but that's between Mrs. McCoy and myself, and it's embarrassing. And I'll tell you this: I met a doctor had put me under. I didn't remember it, of course, and then I later met him. And I apologized. I said, I'm sorry. My wife explained to me that my behavior was unacceptable when I was put under, and that's not me. You've got my deepest apologies. And he said, oh, don't worry about it. It happens all the time. And I said, really? He went, no, not really. so
Can you allude to any of those actions, Phil?
No, absolutely not. Absolutely not. No.
I know what we're talking about during the commercial break.
Suffice it to say that you don't want to put Financial Phil under, I guess, is the story you take.
Well, you do. I mean, if you want a good laugh, you do. But no, Financial Phil does not want anyone around.
Now, this was from Wisdom Teeth, though, right?
It was from, not just wisdom teeth, but yes.
Oh, it's all surgeries?
The funniest story comes from wisdom teeth.
All right.
But I'm not going to share those. We should probably move on to our wonderful markets.
Yeah. Well, but I guess this is kind of a thing now where when you have your wisdom teeth taken out, they put you under. Because when my oldest son had his taken out, they put him under. And it kind of an amusing story from that was because he's had like 20-something surgeries. So he's been anesthetized enough times that he's got a bit of a tolerance. And whatever the dental surgeon is called who does those things, said, I'm a little worried he might wake up in the middle of this because of all the times he's been put under. And sure enough, he did wake up in the middle of it. And I guess you're not numbed. You're just, you're under. So I guess he did wake up. They had to, hurry up and put him back under. And we were supposed to have a follow-up appointment within a week. We called back to schedule, and they said that dentist had quit. So wow. I don't know if that's a related cause and effect kind of thing or not. I don't know. When I had mine taken out, they were done by Novocaine. Back when I was 20-something years old, it was Novocaine, and it was he was kind of like a cousin by marriage. My aunt's nephew, Petey Morabito.
Speaking of Italian names, yes.
And his associate was Joey Cusimano.
You're making that up.
I'm actually not. So I go to call to schedule the appointment, and I said, yeah, he's kind of my cousin, I guess, by marriage. And he was in Northern Virginia, which is where I lived at the time, and my aunt's in Pittsburgh. So I go into the office. They put me in the chair, and he goes, "So how are we related?" And I told him the story, and then I had to come back and eventually get the
that son of a so and so owes me money.
Yeah, so it was pretty funny because they had Petey standing up on the arm of the dental chair, and Joey Cusimano's underneath prying on my jaw while they're trying to pop this tooth out. It was like a Three Stooges short, But they got the job done.
Yeah, sure.
They got the job done.
I had my wisdom teeth taken out about 7 years ago. They were all in. And
wow, that's pretty late.
Yeah, and the dentist said they need to come out. I said, why? I said, well, because you can't really brush them very well. I said, they're going to give you problems. I said, well, they're not giving me problems now, but they will. And so you finally I had so it was only about 7-8 years ago.
Your 4 wisdom teeth came in, never gave you any trouble.
No,
that's amazing.
And I still have my wisdom teeth. Have never pulled them.
I can't believe I've met 2 people that's on the Facebook page. I want to know if you have your wisdom teeth still. That's the comment. Put it on there. I still have mine. So 1 of them, 4 of them, or what age you got them taken out at? Because this is unusual to me. Most people get them taken out in their 20s.
Yeah.
Phil, let's talk markets. Now that the laughter is over, let's talk pain. Because this
37,000 is a lovely number for the Dow.
Oh my goodness, this is nasty. I'm looking at the European markets today, Phil, and the Asian markets, and red is the appropriate color. So during your 638 appearance, I mentioned to you that I hadn't seen numbers like this since March COVID stuff. You had the Shanghai and the Nikkei both losing more than 7%. The Hang Seng lost more than 13%. European markets are all down at least 4% or 5%. And then locally, pre-market, our losses are coming back down near 2% now on either side of it by just a little, which is better than they were this morning following a brutal Friday. Your take on this, and how much lower could this go?
Well, there's a lot of unknowns there, and you hit the nail on the head when you referred to it back to COVID. Those were the worst 2 days that we had since March of 2020, and it looks like today is starting off much the same. And my fear and our fear here out of Winchester Avenue isn't so much how far will the markets fall, but it's how people react to what we're currently seeing. So there of course, and you have a reason to be afraid. I'm not discounting people's fear when they look at their portfolio, but we do need to break down the construction of people's portfolios and where you are in your life. So if you're 25 and you have 40 plus years before you start touching your money, you probably shouldn't be afraid. You should probably just ignore it and move on. If you're in, say, 60, 62 and you're running up on retirement, the construction of your portfolio should have been looked at a long time ago. And what I mean by that is there is a part of our markets. We have so much focus on the S&P and the Dow and the NASDAQ and individual companies, and we listen to shows that talk about, and in large part, they talk about day trading, what they're going to do the next couple of days, if anything, and that causes a lot of fear, and we parlay that into we're going to run out of money, and now I have to change my plans. But when you look at the construction of your portfolio, it should be made up of more than just stocks. You shouldn't have, unless you're someone that doesn't rely on these funds for your daily activities, and they're more far out. You're pushing them far out, like a 25-year-old, or I don't need these. I am retired, but I don't need these funds. My pension, Social Security, have plenty of cash, so forth and so on, where I don't need these funds in the near term. But if you need these funds in the near term, and those are probably the people that are most fearful, look at the construction of your portfolio, because it shouldn't just be made up of equities or stocks. It should also be made up of bond or bond replacements. And we've really been down on bonds in the last 5 to 10 years, but they're showing why they need to be in people's portfolios, because the bond market's doing okay right now. That portion of your portfolio is doing just fine. And if that's the case, then your plan shouldn't have changed just because of what's going on right now. If you remove all the headlines, if we remove the political aspects of this, and we remove the tariff talk, and someone said to you that in the last 2 years, the S&P 500 had returned 24% and 23% year on end, and then in the third year, we hit a correction, would that be abnormal? Would you think, oh, my goodness, the world's coming to an end? In reality, what we're seeing is fairly normal. This does happen. It happens at the end of a bull market, and maybe we touch bear markets today. I think the NASDAQ already has. It looks like as we open that we'll certainly touch it up on the open, because we're really close to bear market in the S&P and the NASDAQ. But at the same time, it is, if we can remove everything and look in the vacuum, it is normal and how the markets are behaving. But here's where the real damage can happen. It's not damaging for someone's portfolio to fall 5, 10, 15%. That's not damaging. It shouldn't be damaging to your long-term aspects. What's damaging is what you do when that equity portion falls. And we have an illustration, and I'd like to kind of express it on air, even though you don't have a visual of it. But in the last 30 years, the S&P, if you just stayed invested the way that you were in the equity portion of your portfolio, the S&P has given average return of 10.45%. You made no movements in March of COVID. You didn't do anything. You didn't do anything in the last couple of days, and you don't plan on doing anything today. You just wrote it out. Your average return would be 10.45%. Here's the fear. missing the best days of the year. If you miss the best day of the year, and there's no way to know when that's going to happen because they do happen during these periods. If you've missed the best 5 days over the past 30 years, your return will have dropped almost 2% just by missing those 5 days. Though another 5 days, if you've missed the best 10 days, it has now dropped 3%. That goes all the way down to missing the best 30 days of the best 30 of the last 30 years. Your average return is now 4%. So 4% opposed to 10.45%. And that is the danger because it's a two-pronged question. If you said, hey, I sold out last Wednesday, if you were someone that did that, you got really lucky and you sold out before the tariff talk on Wednesday. Well, okay, you've won half the battle. When's the other part? How are you going to win the other part of the battle? Because the other part is to come back when the market has reached its floor. And no one knows when the market has reached its floor. This is a man-made, created crater, if you will, for our markets, and it can be repaired by man-made actions. And we have no idea when that's going to happen, whether it be in a week, a month, a year, 2 years, 3 years. It's hard to tell. No one really knows. But what we do know, that the best days come during this, and you need to participate in those days that are up 4 and 5%, because I can assure you, unless you're incredibly lucky, you don't know something that everyone else knows, and you're not going to be able to come back on the day, the morning that it recovers. The other part to it is when you look in most investments, and especially 401ks, so for retirement plans, those are in mutual funds. So you can't decide at 9:30 in the morning, hey, this is really bad, I'm getting out now, because you're still subject to what happens that day. It's not going to trade or sell until the end of the day. And same thing when you try to come back. You can't say, uh-oh, look, we see a bunch of green, and now we're going to bounce back, and all the tariffs have been rolled back, so I'm coming back. Well, what normally happens is you try to come back, say a Monday or Tuesday morning, if there's not restrictions within your plan that doesn't allow you to. But if you try to come back, say Monday or Tuesday morning, you're not going to get that until the next day. So those big jumps that we get during these periods, you have missed it completely, and you probably just caught a falling knife and continued to fall on day 2 or 3. So the danger isn't so much with what's going on. The danger is the human reaction or the emotion that we apply to it.
Phil, you listen to, maybe you don't, but you watch the news cycle. You know that there's an exclamation point. There's 5 exclamation points to everything that is going on. It's terrible. There's an existential threat to everybody's 401k plans right now. It's panic is what obviously sells, drives the clicks. If I'm 55 years old or 45 years old and I'm about to send a kid to college, knowing how I should have balanced my portfolio 5 years ago is supremely unhelpful. So what do I do? If I've got $300,000 in my account, whatever I've got, pick a number, I would argue, my instincts would tell me that, all right, I've already lost $25,000, $30,000, whatever I've lost. Doesn't it make sense? I'm going to need $120,000 over the course of the next 4 years to pay for my kids' education. Doesn't it make sense to pull that much out now in cash, put it aside, and just fine? I'll take the hit on what it doesn't earn, but at least I have that cash, and I've stopped the bleeding on that much cash. Doesn't that make some amount of sense?
So if you're leading into this in your portfolio or whatever the need was, so we're using college as an example, if whatever the need is, if it wasn't built correctly, is that what you're asking? So I wasn't built correctly, I'm in all equities, and I have a kid going to school next year, and I never should have been here,
right?
Then, yeah, it probably would be like, yes, I mean, do it as soon as possible. You should have done it long ago. It should have been done 2 to 3 years ago. Now, if you were in, and this isn't, I know what point you're trying to get at, like what do I do if I wasn't built correctly? But if you using the college plan as an example, you probably were in an age-based college plan, and that would have done it for you. In your 401ks, if you have a target date 401k, which are becoming very popular, have been very popular for the last decade or so, they would have done that for you. So you would have had a certain amount of money set aside in bond or cash replacement, some sort of money market or something along those lines, getting some interest. But yes, if you're built wrong, and you look at your portfolio today, you should have done it long ago, but if you look at your portfolio today and say, oh boy, I need $100,000 in 2026 or at the end of 2025, and all of it is in the equity portion of the portfolio, yeah, you're in a really bad spot. And to keep from making a mistake even worse, you probably should put it aside in some sort of safety preservation or cash account. But the point being, though, is, for long-term money, if it were built the correct way, you really don't have anything to be concerned about. It is concerning, and it does hurt, and it's painful. You got to get through the emotion of it. But if you were built the correct way, this is normal. This is expected. This was built into the Monte Carlo simulation of when I could retire. All of this was taken into account. But if you were built improperly, yeah, you've got a little bit more to be concerned about.
And if I just decide that right now, okay, I've learned my lesson, I need to rebalance my portfolio, is this the wrong time to do that? Because I have to sell my equities in order to buy the bonds and to rebalance, right? So is this the bad time to do that?
Well, no. I mean, if you need it in the near term, because you don't know when that's going. We don't know when the bottom of this is going to be. We don't pretend to know what the bottom of this is going to be. So if you need it in the near term, yes, sell it immediately. But you shouldn't have been built that way to begin with. But if you were improperly constructed, then yeah, you need to set that money aside so you don't worsen what the issues that you already have are. But if you're built properly, you don't have much to be concerned about.
Phil, let's go to the psychological aspect of this. This has been driven by tariffs, and the justification of the tariffs was that over the many years, the U.S. has been taken advantage of by all countries. We've been the victim of the other countries' growth at our expense, so on and so on. Yet the numbers would indicate something altogether different. The numbers show that looking at gross national product, gross domestic product, savings, salaries, most any parameter you want to look at, the U.S. and its workers have done much, much, much better than any other country. Europe, China, regardless of the countries are. Our growth in every respect has been substantially more than what we've seen other countries. And the numbers will verify this, or at least documented for the last 30, 40 years. Is there a sense that within the market itself that we have been led down a path that was not really necessary or justified?
Yeah, there's with a lot of people, and opinions vary, drastically on the whole tariff subject. You have some that support what's going on. You have some that say, yeah, we need some reciprocal tariffs, but not as drastic as what we've done. And then you have a lot, probably 51% that say we shouldn't have done this at all. But at the end of the day, I think what they're trying to accomplish is to get that deficit in line and support the income tax cuts, the continuation of the 2017 tax cuts, and maybe even further that. And by using these tariffs to enhance our revenue to replace income tax, that would be the justification for it. Whether it's good for the markets or the economy is yet to be seen. We could point back, and a good friend of mine sent me an article about tariffs. I think it was in the early 1920s, 30s, something like that led to a recession. And honestly, I didn't read the article, but I've seen that before. But having said that, that was over 100 years ago. So will this end up being the same way? Answer is we don't really know. What we rely on is companies making money. We've always said that companies will find a way to make money. The uncertainty of all of this and what we thought on Tuesday the uncertainty of the tariffs is what has led to our markets falling as drastically, or the volatility that we'd seen up to that point. And then when they announced these tariffs, it's like, oh boy, that's not uncertainty anymore. These are drastic. But will they remain? I think there's still a lot of uncertainty that remains. How long will they stay there? What will the impact be if they stay there? Will there be concessions for companies that agree to come back to the United States, so forth and so on? But from the pure basis of the emotional aspect of it, all of us, me included, we tend to go back to the high point of the S&P 500, or the high point of our portfolio, and then start to measure it from there. And that's not really fair. It's kind of making it more dramatic than what it really is. We should probably look at a moving average of where our portfolio or where the S&P was in order to gauge like how far we've fallen and where are we. But it is an emotional time right now for a lot of people, because this is brought on in some aspect, or a lot of aspects, by politics, and we fall on different sides. Everybody falls on a different side of those politics, and it makes the emotional part of it even worse. But in a vacuum, we have to look at what could the potential be for our markets, and in a vacuum, even further on a personal basis, how it goes back to how were we built, how was our portfolio constructed, and what does it mean for me? Does it change if 2 weeks ago or a month ago your portfolio was valued at $1 million and now it should be around $900,000? Does that materially change where you are in your life? Does that materially change your net worth? And the answer should be probably not. And if it does, you probably weren't built the same way anyway. Back to John's example of the child going off to school, and if you weren't built the proper way, you got a problem.
Financial Phil is just about ready to wrap up his session and move on to some other bigger, better things in his day. And I know that will be a lot of things, Phil, including several phone calls along the way here, too. And I want you to know that I appreciate the fact that when you get into situations like this, and I'm being totally serious here, Bill's laughing already like I got a big setup here. These are stressful times for financial advisors, too, because you're playing the role of psychologist right now as opposed to financial advisor in many cases.
Yeah, and we are taking a lot of phone calls, and this sounds like a commercial, but most of those phone calls, especially Friday, were people that said, hey, my emergency fund is built up a little bit more drastic than what it was before, and I want to throw some money in. So it does go both ways, where we need to be on from our standpoint, yes, everything is cheaper than it was a few days ago. And, you know the old saying, and there's a reason that everyone says it, is buy low, sell high. So you're looking at lows right now, but that doesn't materially change who you are as an investor and what your goals are. So if your asset allocation is 60% equities, it should remain there, even with what's going on right now. If it drifts, if you threw a few thousand in cash and it goes up to 63%, that's okay. That's still in line. But you have to be disciplined on both ends of this equation. And we have had a lot of people throw cash in the last couple of days. We've had more of that than we have had people calling with concern.
How do we reach you for more information today, Phil?
You can reach us at 304-263-4343 or stop by and sit with an appointment at 1270 Winchester Avenue right here in Martinsburg.
Thank you, Phil. Have a great